Good afternoon, everyone. Please come to AS3 cash flow statement one more time. One concept is pending. I had promised you I will take it at the end. So write down in the notebook, write down first 2-3 lines note we will write, and then I will give you 3 examples on this. Write down treatment of foreign exchange, treatment of foreign exchange in cash flow statement, treatment of foreign exchange in cash flow statement, treatment of foreign exchange in cash flow statement. So write down, there may be two types of transactions. 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 A, write down where foreign currency monetary items, where foreign currency monetary items, where foreign currency monetary items are remeasured to closing rate, where foreign currency monetary item are remeasured to closing rate, where foreign currency monetary items are remeasured to closing rate. Write down in bracket, refer AS11. Refer AS11. Now please go to AS11. Do you remember AS11? Do you remember AS11? AS11 was effect of changes in foreign exchange rate. Effect of changes in foreign exchange rate. AS11 was called effect of changes in foreign exchange rates. And under this standard, if you have monetary item, example of monetary items are debtors, creditors, bills receivable, bills payable, cash in hand, cash at bank. These are the examples of foreign currency monetary item. And what AS11 says, they will have to be measured at closing rate on the balance sheet date. Monetary items will be measured at closing rate on the balance sheet date. So write down now, when foreign currency monetary items are remeasured to closing rate. Example of foreign currency monetary item, debtors in foreign currency, creditors in foreign currency, cash in foreign currency, bank account in foreign currency. So if you are just going to remeasure them, it is unrealized exchange difference. It is called unrealized exchange difference. So once again I will explain. Suppose debtor $1,000 originally recorded at 70,000 rupees when the sale was made. On the balance sheet date, exchange rate is 75 rupees. So what I will have to do, I have to remeasure the debtors at closing rate 75,000. Journal entry would be debtors account debit 5,000 to exchange gain to exchange gain 5,000. Now this is an unrealized gain because we have not yet realized the debtor. Debtor is still outstanding on the balance sheet. It is only because of change in exchange rate, debtor value has increased by 5,000 and exchange gain 5,000 has appeared. Now one more example, because that example is required to understand the next question. Suppose we have cash in foreign currency. Suppose we have cash in foreign currency dollar 1,000. Opening cash balance in dollar 1,000, it was valued at 70,000 rupees. On the balance sheet date, exchange rate is 75. So my cash in hand in dollar 1,000, its rupee value will become 75,000. So the journal entry would be cash account debit 5,000 to exchange gain account 5,000, but this is also unrealized gain. This is also unrealized gain because it is just the change in the value of exchange rate. So these are called exchange difference. These are called exchange difference. So what we will do, eliminate exchange difference in cash flow statement. Eliminate exchange difference in cash flow statement. Because it is not yet realized in cash, it is not a cash flow, eliminate it in cash flow statement and also give the contra effect in respective foreign currency monetary item. So while preparing cash flow statement, remove from cash flow statement and also adjust in respective foreign currency monetary item. For example, in the previous case, while preparing balance sheet, we will record the entry debtors to exchange gain, but while preparing cash flow statement, I will reverse it. Only for cash flow statement purpose, exchange gain account debit 5,000, just reverse it and to debtors 5,000. You will reverse it. If it is cash, then exchange gain to cash or bank. If it is creditor, exchange gain to creditor or a creditor to exchange loss. So that means since it is unrealized, it is not a cash flow, it will be removed from cash flow statement with the contra effect in the respective monetary item. In case the monetary item is cash and cash equivalent. In case if the monetary item is cash and cash equivalent, you have to prepare a reconciliation statement because the balance as per cash flow statement and balance as per balance sheet will not tally. Why balance as per balance sheet and balance as per cash flow statement will not tally? As per balance sheet, we will take it at closing rate. But in the cash flow statement, we have removed the effect of exchange gain or loss. In the cash flow statement, we have removed the effect of exchange gain or loss. Whereas in balance sheet, we are going to record it at closing rate. So therefore, a reconciliation statement will be prepared. And what will you show in that reconciliation statement? balance as per cash flow statement plus minus exchange gain or loss, and that will give you balance as per balance sheet. Okay. Now write down second point. Other students write down second point. Please write down the second point now. Other exchange differences are called. Other exchange differences are called realized exchange difference. Other exchange differences are called realized exchange difference. If the exchange difference has been realized, no treatment in cash flow statement. It is realized means cash flow has been collected. If debtors have been collected and at the time of collection there is some gain or loss, it has been realized. So that cash flow has actually been realized, no further treatment required, no accounting treatment required. So in short, if it is unrealized exchange difference, you will eliminate in the cash flow statement with a contra effect in respective FCMI, and if it is a cash and cash equivalent item, a reconciliation statement will be prepared. In case of exchange difference which have been realized, no further treatment is required because it represents cash flow. Because it represents cash flow. So when cash flow has actually been realized, no adjustment required. So would you like to write one question on this? Would you like to write a question on this? This was little tricky, not explained in ICI material, not explained in study material, but it is a part of accounting standard 3. So we cannot ignore it. Write down one question. Write down one question, an easy question, but then you will see the application of this paragraph. Only this much is the question. An entity, an entity has bank balance, an entity has bank balance in foreign currency, an entity has bank balance in foreign currency aggregating to USD, aggregating to USD 100, aggregating to USD 100 in bracket equivalent to rupees 5,000, equivalent to rupees 4,500, equivalent to rupees 4,500 at the beginning of the year, at the beginning of the year, presuming no other transaction taking place, presuming no other transaction taking place, the entity reported, the entity reported a profit before tax of rupees 100. The entity reported a profit before tax of rupees 100 on account of exchange gain, on account of exchange gain on the bank balance, on account of exchange gain on the bank balance in foreign currency, in foreign currency at the end of the year, in foreign currency at the end of the year. Very important question for 4 marks, yet to be asked in your exam, to be asked. What would be the closing cash and cash equivalent? What would be the closing cash and cash equivalent as per balance sheet? What would be closing cash and cash equivalent as per balance sheet? One more thing, write down. Prepare cash flow statement extract. prepare cash flow statement extract, because we don't know other part of cash flow statement. This question says assume no other transaction. Now you see on the screen opening balance in foreign currency is $100. Bank balance is a foreign currency monetary item. At the beginning of the year, the exchange rate was 45. So we will write 4,500 rupees. During the year, exchange rate has gone up by 1 rupee. So this company made a profit due to exchange gain. What is the entry they have passed? What is the entry they will have to pass for exchange difference? Bank account debit 100 rupees to exchange gain which will go to P&L account 100 rupees, which will go to P&L account 100 rupees, which means their P&L account is showing 100 rupees, but this is unrealized. This is only due to change in exchange rate. So the standard says this is unrealized. So I will have to eliminate it while preparing cash flow statement. While preparing cash flow statement, I will reverse it. How do I reverse it? I will remove exchange gain 100 and I will reduce the bank balance to 100. But then what will happen? My cash flow statement will show 4,500 plus 100 minus 100. My cash flow statement will show a closing balance of 4,500, whereas my balance sheet will show closing balance of 4,600. So I will have to prepare a reconciliation statement between cash flow statement and balance sheet balance. Okay. So first we'll prepare statement of cash flow. Write down, for the purpose of cash flow statement, please write, for the purpose of cash flow statement, an entity shall present the following. For the purpose of cash flow statement, an entity shall present the following. Right hand side rupees, right hand side rupees. Now in this question, as given in the problem, profit before tax is 100, because we have passed the entry bank account debit to exchange difference account, less unrealized gain. Unrealized gain will be eliminated. In this example, the unrealized gain is related to cash and cash equivalent. So I am going to reverse it because it is unrealized. So what is my cash flow from operating activity? What is my cash flow from operating activity? If I reverse it, it is a non-cash item. I have reversed it. My operating activity cash flow is 0. Cash flow from investing activities. In this question 0. Cash flow from financing activities. Cash flow from financing activities in this question 0. Nothing is given. Therefore net increase or decrease in cash and cash equivalent. So first you will write profit figure, reverse unrealized gain or loss, remaining item as it is. So your total is 0, 0, 0, 0, total is 0. Opening balance of cash and cash equivalent. Opening balance of cash and cash equivalent. Read your question first line. The opening balance is 4,500. The opening balance is 4500. First line I have dictated 0 plus 4500. Your closing balance will be 4500. Cash and cash equivalent at the end of the year. Cash and cash equivalent at the end of the year. Cash and cash equivalent at the end of the year is 4500. This is what cash flow statement will show. But balance sheet will show a different amount, because in balance sheet $100 will be valued at 464600. So we'll have to prepare one reconciliation statement. Write down below reconciliation of cash and cash equivalent. Reconciliation of cash and cash equivalent. Reconciliation of cash and cash equivalent. Right hand side rupees. Right hand side rupees. Point number A. Point number A. Cash and cash equivalent. Cash and cash equivalent as per cash flow statement. Cash and cash equivalent as per cash flow statement. How much was that in the last line? Previous table, last line. Let us call this step number 2. So this figure you will get from step number 1, last line, 4500. Now in order to reconcile with balance sheet, I will add unrealized gain, because in balance sheet we have taken cash and bank at closing rate. So balance sheet figure is higher because there was an unrealized gain. Unrealized gain on cash and cash equivalent 100 rupees. Therefore, cash and cash equivalent, as per balance sheet. Therefore, cash and cash equivalent as per balance sheet 4600. This is called reconciliation. You will take cash flow statement figure plus minus unrealized gain or loss, and this is balance sheet. This amount will reflect in the balance sheet of the company. One more question, write down, related to foreign exchange. Write down next question, small question, do not worry. Next question, write down. Next question, write down Vino Limited. Vino Limited has no foreign currency cash flow. Vino Limited has no foreign currency cash flow for the year 2017. For the year 2017. So there is no other foreign currency cash flow transaction. Now it says it holds some deposits in the bank. It holds some deposit in the bank in the USA. It holds some deposits in the bank in the USA. The balance as on 31/12/2017. The balance as on 31/12/2017 and 31/12/2018 and 31/12/2018 were US dollar 1 lakh, and US dollar 1,02,000 respectively, and US dollar 1,02,000 respectively, the exchange rate, the exchange rate on 31st December 2017, the exchange rate on 31st December 2017 was US dollar, was US dollar 1 equal to rupees 45, was US dollar 1 equal to 45. The same on 31st December 2018 was, the same on 31st December 2018 was US dollar 1 equal to 50. So from 45 it has become 50 now. Yes or no? The increase in the balance, the increase in the balance, which balance? It was 1 lakh and it is 1 lakh 2000. So your question can be, why there is an increase? So the answer for that is, the increase in the balance was on account of interest credited on, was on account of interest credited on 31/12/2018, was on account of interest credited on 31/12/2018. So this is your interest income, was on account of interest income $2000. Thus the deposit was reported at, thus the deposit was reported at rupees 45 lakh in the balance sheet. Thus the deposit was reported at rupees 45 lakh in the balance sheet as on December 31, 2017. So how this 45 lakh has come? Opening balance 1 lakh, opening rate 45, which means the deposit appearing in your opening balance sheet or opening cash and cash equivalent will be 45 lakh. It was reported at, it was reported at rupees 51 lakh. It was reported at rupees 51 lakh in the balance sheet on 31/12/2018. It was reported in the balance sheet at rupees 51 lakh on 31/12/18. How this 51 lakh has come? Understand, closing balance is 1 lakh 2000, closing exchange rate is 50. So if you multiply these two, you will get the closing balance. This 51 lakh will appear in balance sheet. How this transaction should be presented? How this transaction should be presented in the cash flow statement, in the cash flow statement for the year ended, for the year ended 31st December 2018, for the year ended 31/12/2018, as per AS3, as per AS3, as per AS3. So let us just read the question quickly again. This company had an opening balance in bank deposit 1 lakh, closing is 1 lakh 2000, opening rate 45, closing rate 50. Difference 2000 is the interest which was credited to fixed deposit account. Opening cash and cash equivalent 45 lakh, closing cash and cash equivalent is 51 lakh. Closing balance is arrived at by applying closing rate. Because of this, there is some unrealized exchange gain or loss also. So what I will do, in order to make your understanding clear, although not required by the question, but we will pass journal entries. We will see what has happened during the year. So this question is a very good question, which is a combination of AS11 and AS3, and both are in your syllabus. So institute can give you such mix and match problem. So first let us understand, first let us understand, first let us understand the journal entries that will be passed. First let us understand the journal entries that will be passed. First let us understand the journal entries that will be passed. So in this question, two entries will be there. One is for interest income and second is for remeasurement of closing balance. Remeasurement of closing balance. Now write down 31/12/2018. 31/12/2018. You have received interest income. Entry will be bank account debit. Bank account debit $2,000 multiplied by exchange rate on 31/12/18, that is 50 rupees. Bank account debit 1 lakh, 2000 into 50 to interest income. Interest income will be shown in P&L account. Interest income will be shown in profit and loss account. Then next is being interest income recognized. So that is your interest income. 31/12/18. 31/12/18. Now we have opening balance $1 lakh, which was recorded at 45. Now the rate is 50. So I will have to restate the opening balance to 50 lakh, whereas in the books it is 45 lakh. So therefore there will be an unrealized exchange gain of 5 lakh rupees. So please write down, everybody please write down 31/12/18 bank account debit, bank account debit, bank account debit. Then write down 5 lakh to exchange gain 5 lakh, to exchange gain 5 lakh, to exchange gain 5 lakh. Being bank balance revalued, being bank balance revalued, being bank balance revalued 5 lakh rupees. This is unrealized gain. This is unrealized gain, and accounting wise it will go to profit and loss account. Now we'll write down extract of cash flow statement. Extract of cash flow statement. Right hand side rupees. Cash flow statement operating activity. Cash flow statement operating activity. Profit dash dash dash, because we don't have complete idea. We don't have complete idea, so it will include exchange gain or loss also. Less exchange gain unrealized. Less exchange gain unrealized. Exchange gain unrealized 5 lakh. Exchange gain unrealized will be eliminated. Closing cash and cash equivalent. Closing cash and cash equivalent. Closing cash and cash equivalent. 46 lakh. 46 lakh. Your cash flow statement will show 45 lakh opening balance and 1 lakh interest income. 45 lakh plus 1 lakh. Some student can ask, what about interest income? We have written it is an extract, and interest income would have got included in the profit figure. But we don't have the complete idea about profit. So this is enough. This is enough. So it will serve the purpose. Otherwise, you'll have to write like this: profit 1 lakh interest income, 5 lakh exchange difference, 6 lakh. Somebody wants to write like this: less exchange gain unrealized. If you want to write interest income also and profit also, 5 lakh. So you'll get cash flow 1 lakh, opening cash and cash equivalent, opening cash and cash equivalent, cash flow from operating activity 1 lakh, opening cash and cash equivalent 45 lakh, and closing cash and cash equivalent 46 lakh. Closing cash and cash equivalent 46 lakh. So if you want to give the effect of all entries, this is the presentation. If you want to present only extract, this is the answer. So make your choice. Okay. Both are okay. Now the problem is your cash flow statement is showing 46 lakh. Balance sheet is showing 51 lakh. The shareholders will get confused. Shareholder will look at the cash flow statement, oh, 46 lakh. Balance sheet 51 lakh, 46, 51. So you have to give a reconciliation of cash and cash equivalent. So write down below reconciliation. Write down below reconciliation, right hand side rupees. Right hand side rupees. Point number A. Point number A. Closing cash and cash equivalent. Closing cash and cash equivalent as per statement of cash flow, as per cash flow statement, as per cash flow statement 46 lakh. Closing cash and cash equivalent as per cash flow statement 46 lakh. Previous step. And why there is a difference? Because of unrealized gain. Add unrealized gain. Add unrealized gain. Add unrealized gain, write down 5 lakh. Add unrealized exchange gain on cash and cash equivalent 5 lakh. Therefore, cash and cash equivalent as per balance sheet. This figure will tally with balance sheet. So shareholder can look at the reconciliation statement and he can understand the difference is because this is an unrealized item. Okay. So this is the answer of this question. It can be asked for 4 to 5 marks, right? One more last question on foreign exchange we will practice, and after that this chapter will be over. One more question. Write down, write down Z Limited India, Z Limited India. Please write down the question. Z Limited India has an overseas branch in USA. Z Limited India has an overseas branch in USA. Has an overseas branch in USA. It has a bank account. It has a bank account having a balance of USD, having a balance of USD 7,000, having a balance of USD 7,000 as on 1st April 2019. As on 1st April 2019. As on 1st April 2019. During the financial year, during the financial year 2019-20, during the financial year 2019-20, Z Limited acquired computers for its USA office, computers for its USA office for USD 280. This is one extra adjustment now. For USD 280, which was paid on the same date, which was paid on that same date. There is no other transaction. There is no other transaction reported in USA. There is no other transaction reported in USA or India. Exchange rate between INR and USD, exchange rate between INR and USD during the financial year, during the financial year 2019-20 dash 2020 were 1920 dash 2020 were right hand side. This is the USD 1 to INR. So exchange rate, this is exchange rate for 1 US dollar, and this is date. So on 1st April 2019, exchange rate was 70 opening, and we have opening 7,000 USD with us. 30th November 19, 30th November 19, the rate was 71. The rate was 71. Date of purchase of computer. So this $280 which you have paid, that will be converted at 71. Next line, write down 31st March 2020. 31st March 2020, the rate is 71.50. The rate is 71.50. Average for 2019-20. This is average rate. This is actually not required in the answer. Closing rate will be required for translating the closing dollar. Closing rate will be required. This is closing rate. Whatever dollar we have left with after purchasing computer will be translated at closing rate. Prepare the cash flow statement extract. Prepare the cash flow statement extract for the year ended 31st March 2020. For the year ended 31st March 2020, and also show the foreign exchange profitability, and also show the foreign exchange profitability from this transaction, from this transaction for the year 2019-20, for the year 2019-20. Now if you don't practice such questions before you go to the exam, you will not be able to understand what is the question only, right? So we have to learn to understand difficult questions also. So in this question, opening balance is 7,000 USD. Out of that, you have purchased computer of 280. that will be translated at closing rate. From 7,000 you have paid 280, so you are left with $6,720, and that $6,720 you will have to translate at 71.50. There will be some exchange difference when you will translate the remaining number of dollar, that is unrealized gain, and therefore you will have to prepare one reconciliation statement also. Okay, so first I will give you some basic calculations for understanding. We have opening $7,000, we purchased a computer for 280, we are left with $6,720, and that we will calculate, convert at 71.50, and we will see what is the amount in Indian rupee on 31st March 2020. This is the amount that will go to balance sheet. But while preparing cash flow statement, unrealized gain will have to be reversed. So cash flow statement bank balance will be different from balance appearing in balance sheet, and that difference will be presented in reconciliation. So please write down calculation of exchange difference. Calculation of exchange difference. Calculation of exchange difference. Right hand side rupees. Right hand side rupees. Point number A. Point number A. Opening balance. Point number A, opening balance, $7,000 into 70, $7,000 into 70, 4,90,000, 4,90,000. Opening balance, we have $7,000, opening rate 70. Now write down, out of this, you have purchased computer. Out of this, you have purchased computer. So less computer purchased. Less computer purchased. We have purchased computer of $280. When we purchased the computer, the rate was 71. Multiply $280 into 71, and that is equal to 19,980. So now the balance in the books, the bank balance in the books will be 470,120. 470,120. Now we'll calculate the closing balance. Closing balance in dollar terms will be 7,000 minus 280 multiplied by closing rate 71.50, multiplied by closing rate 71.50. So give me the answer now. What is the closing bank balance after converting at 71.50? Please reply. I will wait for your answer. Please reply. So reply please. What is the answer? 4,80,480. 4,80,480. Therefore, the difference will be exchange gain, which will be credited to P&L account. So write down, therefore exchange gain, therefore exchange gain, therefore exchange gain credited to P&L account. Therefore exchange gain credited to P&L account. The difference is how much? Take the difference, 470,120 minus 4,80,480. That exchange difference we will recognize in profit and loss account. That we will recognize in P&L account. So the answer comes to 10,360. Gajanan is right. Gajanan. 10,360. This is my exchange gain. But this is unrealized. This is unrealized. Now write down journal entries. Journal entries are not required in the exam. This is only for understanding. Only for understanding. OF understanding, only for understanding. So what is the journal entry we will pass? Again we'll pass two entries, one for purchase of computer and the other for exchange gain. So entry for purchase of computer, purchase of PPE account debit, purchase of PPE account debit, multiply 280 into 71. 280 into 71. Please reply. 280 into 71. So the amount paid in Indian currency is 19,880 to bank account, 19,880 being computer purchased. Being computer purchased, and we will have to also pass entry as per AS11 for restating monetary item at closing rate. So here the entry will be bank account debit 10,360, bank account debit 10,360 to exchange difference, to exchange difference, to exchange difference 10,360. This we have already calculated in step number 1. So write down in bracket step number 1. Being foreign currency monetary item revalued. Being foreign currency monetary item revalued. Being foreign currency monetary item revalued. So what is the effect of these two entries? Purchase of PPE will come in investing activity. Will come in investing activity. Exchange difference will be part of P&L account, but it will be reversed or eliminated because it is unrealized. And this unrealized exchange difference will form part of reconciliation statement also. So please write down cash flow statement extract. Now the last answer, cash flow statement extract for the year ended 31st March 2020. For the year ended 31st March 2020, right hand side rupees. Point number A. Point number A, cash flow from operating activities. Cash flow from operating activities. Cash flow from operating activities. Under that, write down net profit before tax. Go to your journal entry. Journal entry, you will find you have credited exchange difference P&L account 10,360. 10,360. The problem says there was no other transaction reported by this foreign branch. So less exchange gain unrealized. Less exchange gain unrealized. 10,360. This we will eliminate because it is unrealized. It is not realized in cash. It is just a book entry. So now write down, therefore cash flow from operating activities. Therefore cash flow from operating activities nil. Cash flow from investing activities. Here we will have one item, purchase of PPE. Purchase of PPE in your previous journal entry number 1, 19,980. 19,980. Cash flow from financing activity, nil. There is no cash flow from financing activity in this problem. Therefore, therefore, net change in net change in cash and cash equivalent, net change in cash and cash equivalent, 19,980, 19,980. Net change in cash and cash equivalent, 19,980. Opening cash and cash equivalent, opening cash and cash equivalent, 4,90,000, 4,90,000, 4,90,000. Closing cash and cash equivalent, closing cash and cash equivalent without revaluation, without revaluation, because we have reversed the effect of revaluation. D plus E, D plus E, that will come to 470,120, 470,120. Now the shareholder is confused. The cash flow statement is showing 470,120. Balance sheet is showing 4,80,480. This will appear in balance sheet. So what he will do? He will get confused. So you have to prepare a reconciliation statement and you have to tell him the difference of 10,360 is because of exchange gain unrealized. So write down one reconciliation statement. Write down one reconciliation statement. Reconciliation statement, cash and cash equivalent, cash and cash equivalent as per cash flow statement, cash and cash equivalent as per cash flow statement, 470,120, 470,120 less exchange difference realized, less exchange difference realized, 10,360, less exchange difference realized, 10,360. Sorry, not less, add, it is gain, add. If it is loss, then you will say less. Okay, and that will give you cash and cash equivalent as per balance sheet. 480, 480, 480, 480. Wow, what a score! 480, 480. Now I will just close the answer with a note. Close the answer with a note. Exchange difference will increase the profit of the company. Your query sometimes can be why we are doing all this. Why we are reversing, adding. That is the reply to your query. Interested candidate will write the note also. Exchange difference will increase, exchange difference will increase the profit of the company, the profit of the company by rupees 10,360, by rupees 10,360, by rupees 10,360. but it will not affect cash flow statement. It is not realized in cash, so it will not affect cash flow statement. It will not affect cash flow statement. Hence, to match closing cash and cash equivalent, to match closing cash and cash equivalent, we will make reconciliation statement. We will make reconciliation statement where this profit will be shown. We will prepare reconciliation statement where this profit will be shown. Where this profit will be shown. Okay. So this is the reason why we are preparing cash and cash equivalent and balance sheet reconciliation. This excludes unrealized gain and loss, because as the name suggests, these cash flows are not yet realized, whereas balance sheet items will include unrealized gain and loss also, and therefore there will be a difference between the two, and that difference will form part of reconciliation statement. So I have taken 3 questions going beyond the scope of our work to make you understand. We have taken many questions on this topic, more than 35 questions we have taken, and I hope you have understood how to solve questions of direct method, indirect method, and also foreign exchange unrealized gain adjustment. So with this chapter is over. Thank you very much.